But in any case, without further ado, let me yield the ground to John, who will talk to us about retirement, right?
Yes. Not yet my own, I hope. Actually, Writing Tips was really writing tips for prospective JPE authors after I got tired of writing the same letter to them over and over again. But I wanted to save their egos by saying it was for PhD students. And writing it was the most productive 20 minutes of my professional career because it's apparently the only paper anyone's ever read. So my assigned topic is somewhere between government debt and retirement savings. So let's talk about that. I am going to recycle old papers. There's a paper called Portfolio Advice for Long-Term Investors, which if you like what I have to say, but you've had too much wine to remember it, then go look it up on my webpage, along with some of the fiscal theory. I have to plug fiscal theory because that's what I do. So let's talk about debt, government bonds, in the context of retirement. And my theme will be that long-term government bonds are the best of all investments, and then long-term government bonds are the worst of all investments. And we'll add the reality is halfway in between. Why are they the best of all investments? We've had a really fun day here talking about modern portfolio theory, and I think half of the authors cast our advice in terms of modern portfolio theory. It's kind of interesting because actually portfolio practice honors it mostly in the breach. Most of the time people have buckets: equities, domestic equity, international equity, alternatives, which is just another word for equity, but that still makes it another bucket. But they don't use betas and covariances, and then hire active managers in each bucket to reassemble the market portfolio plus a lot of fees. But we talk about modern portfolio theory, which, if you remember, focuses on a one-period mean and variance in returns, thinks about assets in terms of their alphas and betas. In that theory, where do bonds show up? The risk-free rate is short-term government debt. That's the cornerstone, the risk-free asset, something like T-bills. Long-term debt, if it appears, it's terrible Sharpe ratio, a lot of volatility. So we start talking about it as kind of a diversifier, and we start talking about is it positive or negative beta, and that's how we think about debt and risk-free assets. That is all completely wrong, and that's my first thought. What is, in fact, the ideal portfolio for a risk-averse, an investor who wants safety, a risk-averse long-term investor? It is not one-month Treasury bills. It's an indexed perpetuity, a security that provides a $100 real coupon and indexed for inflation forever. I wish I had thought of that. Campbell and Vieira thought of that. They came to the University of Chicago in the mid-2000s, gave this who should buy long-term bonds. They stated this theorem, and it's one of several times in my life I've gone, why didn't I think of that? It seems so bloody obvious when you're done, and I completely didn't know it ahead of time. But yes, the risk-free asset for a long-term risk-averse, the best asset for a long-term risk-averse investor is an indexed perpetuity. It is not cash. It's funny that we don't know that. If you watch Downton Abbey, their investments were Queen Victoria's perpetuities, which under the gold standard were essentially indexed perpetuities. They understood that's the risk-free asset around which you build your portfolios, and that short-term bonds are risky. Yes, short-term debt is risky. For a long-term investor, there's reinvestment risk. Interest rates might go up or might go down. It's much riskier. Short-term nominal debt has inflation risk. This is another verity which even I thought it was true until 2000, right? If inflation goes up, short-term interest rates will go up, so short-term debt is at least inured from inflation. What happened 2000 to 2022? What happened was inflation went to 10%, short-term debt stayed at absolutely zero, and you lost 15% of your shirt on long-term debt because of low real interest rates. That shows up in models with sticky prices. That is why short-term debt the inflation doesn't go down to the short-term debt is essentially what happens, and that's what happens in reality. So even short-term debt, you're even exposed to inflation risk. That's the risky one. Now, stated this way, it's so obvious. The long-term, the risk-free, I hope you're having a John Campbell moment, unless I can see Andy Abel knew this already, but most of you have read that paper already. But why is that such a hard sell? Why is so much of practice, so much of your clients or whatever, thinking of cash as the risk-free investment and long-term debt as some risky thing with nebulous Sharpe ratios and betas? Well, it's a hard sell, and I think a lot of our job is a marketing job. Imagine, I like to state this as, imagine you're a finance professor and your spouse is not, and your spouse says, put it in something risk-free. You put it in an index perpetuity as close as you can get with long-term tips. And the next month, interest rates go up. You lose, 20% of the value of your portfolio. Your spouse opens up the envelope and says, "You bloody moron. I told you to get something risk-free. You put it in this strange tippy thing, and we just lost 20% of our wealth. What do they teach you over there in PhD land?" Now, more seriously, that would happen with delegated management. If your client says, "I want the risk-free thing," and you say yes, and they open the statement, you say, "You bloody moron, you just lost a lot of money." How do we communicate that? Well, I think one good way of communicating it is don't open the statements. If you could just, and I think it's, okay, now honey, calm down, let me explain it. So here's your job. How are you going to explain this? One way is, don't worry about the price. We get that cash flow guaranteed forever. I think that's good marketing. Now the problem is we have a theory. There was a theory in 1972 that explained this. This is the Merton portfolio theory, with state variables for investment opportunities, which all of us have taught, and all of us have passed the test, and then we forgot it instantly, completely unused in practice. How does Merton handle that same situation? Well, long-term bonds are risky because the price can go down, but every time the price goes down, the yield goes up, and magic will make it up in the long run. But accounting for state variables for investment opportunities seems to be completely bad marketing. And if you try to explain to your spouse, "Don't worry, honey, we lost 20%, but we made it up on the investment opportunities. The yield is higher." You're gonna get it. And nobody calculates alphas and betas and hires and fires investment managers because they lost a lot of money, but the state variables look real good this month. So I think focusing on the cash flows is also a good way to think about that central marketing. It also, I think, it explains a lot of something we talked about today, the expansion of private credit, private equity, alternatives, which are just other ways of labeling things, but you don't mark them to market. You tear up the envelope. You do what my friend Chris Asness has called volatility laundering, but maybe for a reason. It's helpful to tear up the envelope. So it's all clear if you look at cash flows, and I think that would help us focus on what really matters, how to deliver a consumption stream, not wealth next quarter. And that's my second. So story number one, the index perpetuity. Story number two, ask the right question. How did we go wrong with one period? We said, well, we're worried about wealth next quarter. But they're not worried about wealth next quarter. What they want is that stream of consumption. So ask the right question. Now that leads to the real world. How do we do this in the real world? Well, there's tips. Tips are awful. I love you, Larry Summers. Thank you for inventing them and giving us something of the sort. Why are they awful? As you know, the tax treatment, that if there's that you have to pay taxes now on the principal value going up because of inflation. They're asymmetric. They pay you for inflation, not deflation. There are way too many different maturities. They are not an indexed perpetuity. There's way too many maturities. They're illiquid and so forth. There's arbitrages between tips and inflation swaps and so forth. So certainly, the US government should issue indexed perpetuities, symmetric with a decent tax treatment. That's what people want. Queen Victoria knew how to issue these. Why can't we issue simple indexed perpetuities? And I think the U.S. should make all of its long-term debt perpetuities, so we would have 2 QSIPs, not 673. You want liquidity in bond markets. That would help a lot. But the private sector could help too. Why is the U.S. government the only entity issuing long-term indexed bonds? At least indexed strips. Why don't we, let's start a business. Let's put together corporate, foreign mortgages, CPI swaps, whatever it does to create and then sell either a perpetuity or a long-term strip that is indexed and sell it to people. Now, to some extent we have that, and it was interesting to talk about today. Annuities and defined benefits are that security. Now, how we hedge them is there's a lot of implied risk there. But so we kind of understand that on the selling issue, but not on the investment issue, and not for so many other people. Annuities are also, they're sort of the answer, but sort of not. We talked about the puzzle. Why don't people buy annuities? And I'll just say, if you're buying annuities plus life insurance, you're missing the point, right? Because the perpetuity is that you can leave it to your kids. So if you're buying annuities and life insurance and you want to leave the house to the kids, you're missing the point. Now that's if people are risk neutral. People are not risk neutral. They want more risk and return on top of that. Should be our risk-free rate. And so, but you can think about stocks in the same way. And once you start thinking about stocks as a sequence of cash flows rather than one period returns with lots of state variables, I think a lot of things change. And one thing that changes is we take for granted that in our retirement planning, we have these target date funds, and the idea that you should invest in stocks when you're young and bonds when you're old. That's predicated on the notion that your wage is a bond-like investment, and you have this stocks, and then when you retire, you've lost the bond-like investment, so you should move more towards bonds. But if you look at the cash flows, we don't know what the mark-to-market value of wages are. If you look at the cash flows of wages, and especially the cash flows of the average stock owner, which is somebody who owns a small business, that looks a lot more like a stock than like a bond. So in fact, people, that whole portfolio advice may be wrong because the wage income, the business income, is a stock-like income, not a bond-like income. And stocks, like bonds, when prices go down, expected returns go up. So they too have advantages for the long-term investor who should start thinking more about, Bob Shiller said it, buy stocks for the dividends and tear up the statements. Thought 2. Now that's one way of thinking about bonds. The other way of thinking about bonds, very popular, and especially at Stanford these days, is in terms of liquidity value, collateral value. Treasuries are like money, exorbitant privilege, safe asset shortage, savings gluts, supply and demand, price pressure, all the exciting things going through academia these days. How does that impact our question, which was, in case you've had too many glasses of wine, how we think about bonds and retirement investing? Well, it all adds up to a claim, which may be true and maybe not any more true, that treasuries are like 1% lower yield than similar bonds that don't have their money-like or whatever it is characteristic. I think there's some suspicion that's largely over because, like money, the government printed it up until the rates of return are equalized, but maybe not, that there's still a AAA spread. I don't know. If this is true, how does this influence your thinking? And the answer for the long-term investor, it's a whole other talk about bond investing for arbitrageurs and speculators. Not today, we're the long-term investor. But the other piece of wisdom in life is don't buy stuff you don't need. So don't buy the extra baggage allotment on the airline if you're gonna just have carry-on bags. Don't buy liquidity value if you don't need liquidity value. That's perfectly obvious. We don't put our money into cash stuffed in mattresses. Why? Low return. Is that a behavioral anomaly? No, it has a liquidity value. If you don't need the liquidity value, you put your money in an interest-bearing thing. So the same holds true for bonds. If you think government bonds have this liquidity value, then you should be investing in off-the-runs, corporate bonds with CDS coverage, maybe the foreign bonds that don't have the US Treasury special, whatever it is, or at least we should be synthesizing that and then selling a higher yielding product. Don't buy stuff you don't need. That's all we need to know about liquidity. That brings me to my third thought. Long-term government bonds are the worst of all investments. And I think that's what I was invited for, knowing my doom and gloom and tendency when it comes to government debt. In 1345, Edward III defaulted on a big loan, ruined the Peruzzi and the Bardi, and set off a financial crisis in Florence. Florence was run by the Medici, not by the Peruzzi, thanks to Edward III. Since then, sovereign debt globally, till today, has been mostly a stream of disappointed hopes. A few good times have happened, but largely when you look at, the French Revolution, contemporary Latin America, the idea that government debt is the risk-free asset is the hubris of an ahistorical and somewhat xenophobic age. What happens in Greece and what happens in Argentina can happen here. And of course, that's what I'm here to warn about. Now let me put on my economic hat for a minute. Another principle, which I hope I can rescue out of the fog of a good dinner. Government debt is also a good and great thing. Yes, this is my Hoover tie. I came from the Hoover Institution, and I will say this out loud. It's a good and great thing. Why? Barrow tax smoothing. Government debt allows governments to borrow an enormous amount of money in a war, in a crisis, in a pandemic, if you spend it wisely, and then to pay it off over decades, thereby charging a small amount of tax over a long period of time rather than a huge amount of tax in a short period of time, and possibly more than they could have gotten the money. It's a great way. That's how England beat France in the Napoleonic Wars. Government debt is a good and great thing, properly managed. But there is also the Lucas-Stokey state contingent default. Tax smoothing happens not just over time, but over states of nature. Governments should also, when they run into a once-in-a-generation, once-in-a-century crisis, default or inflate away a considerable part of their debt, sparing taxpayers the distorting taxes. That is actually the theory of optimal taxation, and that can come via inflation. There's a fundamental difference of government debt versus private debt. Private debt is the present value of coupons backed by a real investment, by factories, by houses that you can repossess, seize, and get paid off. The real value of government debt is the present value of primary surpluses. You knew I had to say that, right? That's a claim on future taxes. You can't seize the Grand Canyon. You certainly can't seize future tax payments. Government debt is a hope that future generations will vote themselves taxes in excess of spending in order to honor debts that we racked up in order to go on a grand consumption binge. Why are they going to do that? Well, because it's the right thing to do, or to maintain their reputation of the US government so that they can borrow in their term when they need to. But you can see that that's a much more tenuous force than the force of regular debt, which is why government debt had so many problems for so many years. Worse, government debt is a shorter maturity instrument than the taxes that back it. Since we don't issue Queen Victoria's perpetuities, we issue short-term debt that roll it over. That means government debt is subject to rollover risk, and there's a sort of a Keynesian beauty contest or run. You don't buy a 5-year treasury because you think the government is going to run surpluses in the next 5 years to pay you off. You buy a 5-year treasury because you think 5 years from now there'll be some other idiot who's willing to give the government money to pay you off. And as we all know, that faith can unravel quickly. Don't worry, the US never defaulted, you say. This is all, too much right-wing worrying. That's false. The US government has defaulted many times in many ways. There has been a substantial inflation, which inflates away nominal debt after every single war. Revolutionary War, I don't know about 1812, I should have looked that one up. Civil War, In the Civil War, we eventually went back on parity and paid it back, but you had to wait 20 years. World War I, big inflation. World War II, about a 40% inflation the minute it was over, and then a little bit more. Korean War, Vietnam War, and the war against COVID. COVID was fought exactly like a war. Now, whether the spending merited what we spent World War II levels, whether it was spent wisely or not is a question I don't want to argue about, but we fought it like a war with the usual results. And this is kind of, you knew I'd get to fiscal theory sooner or later. Something I've just learned recently is very interesting. The inflation does not come at the beginning of the war, when Lucas and Stokey said it would come. It comes at the end of the war, or after the war, when we decide, in the old days, are we going back to parity or not? In the new days, are we going to pay it back or not? That's the decision that causes the inflation. So anyway, the US has done it many times. If you hold bonds, short-term bonds or long-term bonds, you just took a 15% haircut, thanks to the US government. You contributed your bit to a Lucas Stokey state contingent default to pay for the COVID spending without current or future taxes. Congratulations, but you might want to think about if that's going to happen again. And of course, we won most of our wars. Governments that lose their wars don't pay back anything. So, government bonds to Germany in the two world wars didn't do that great. Government bonds to the UK, which just had stagnation after World War II, didn't that great either. And there has been explicit default. This is the doom and gloom part. There'll be an optimistic ending, don't worry, but have a little wine for the doom and gloom part. We have in the past. Even Alexander Hamilton did not pay back principal and interest on everything, and the currency inflated away. The gold clauses, we defaulted on them in the Second World War. And ask yourself, really, in the last debt ceiling fight, there's certainly in debt ceiling fights, there's a chance of a technical default, you gotta wait. Our government, faced with the decision, do we pay principal and interest to bondholders, Wall Street fat cats, and foreign central bankers? Or do we keep the Social Security checks running on time? Are they really going to prioritize the honor of the U.S. in its debts? They have said no. In the last one, both the Treasury Secretary said, I don't know if we're paying back the interest on the debt. And the Fed said, I don't know if we're going to take debt at face value and give you liquidity. Now, they may have been playing games with Congress, but nonetheless, a technical default could happen. It would be a financial catastrophe. Fortunately, our long-term bondholder doesn't care, because eventually they'll pass the debt ceiling and you got paid off. But an actual default is also much more possible than you think. It's never clear-cut. The scenario we're thinking about is not you wake up one morning, the bond vigilantes come, the US government says, sorry guys, 80 cents on the dollar. The way these things always happen is you do not call it default, please. Call it a restructuring. Call it a workout. Those maturing Treasury bills, you're going to get 2% coupon 30-year bonds that aren't marketable for the next year or two. There will be financial repression, as maybe there already is. Ye banks, I really want you to hold, for stability reasons, you need to hold more government debt because that's a safe asset. And by the way, you need to hold it at sort of artificial prices. Insurance companies, pension funds, regulatory needs, you need to hold government debt. Capital controls. Already there's been threats to tax government bonds. So taxing government bonds after you bought them is equivalent to a default. Not just the foreigners, a wealth tax on government bonds. And indeed, governments that face a fiscal crisis passed wealth taxes. In that sense, where do you hide? You might say, well, I'll hold corporate bonds because, they'll default in the treasuries, the corporates will be good. Sorry, they're going to pass a wealth tax on the corporates too as we get to a real debt crisis. So what is the danger? I think today, lots of people talked about the danger. I don't think you were facing the real danger. The danger is not slowly rising interest rates and crowding out and some sort of stagnation. The danger is not even that the bond vigilantes wake up one day and say, here it comes. The danger is the next crisis. Let's say China blockades Taiwan. That could happen. Or there's another pandemic. What happened? But China blockades Taiwan. What happens? Trade comes to a halt. Financial crisis 101. What does our government want to do? Well, we'll start with, we got to bail out the whole financial system again because, oops, sorry, we never got around to solving that problem. We need stimulus checks all around. Oh, this time we need to borrow money like crazy for a real military situation. And something we talked about today, contingent liabilities. Our government has guaranteed, well, all the banks, of course, all the home mortgages in the country. I found myself thinking defined benefit pensions and even defined contribution pensions. Suppose we replay 1933 or even 1974. The stock market goes down 50% and stays there. Well, all the defined benefit pensions are out. Certainly Uncle Sam's going to want to bail them out. And the defined contribution benefits. Do you really think that 300 million voters who just lost 50% of their retirement savings are not going to be made whole by Uncle Sam? So well, how do we have a river of cash? But what happens now? The government goes to the bond markets and say, I want $10 trillion of fresh new savings that you will hold on to as a great investment for 20 years. And bond markets saying, are you again? What's the plan to pay this off? Could I see the cash flow projections? And that plan is 5% primary deficits forever. Oh, and by the way, last time I gave you $5 trillion in COVID, you gave me a 15, 20% haircut on that. I'm not doing that again. So you can see that inflation could break out very quickly. And more tragically, the US could find itself unable to borrow the money that it needs to put out the fires. The loss of fiscal space is, I think, the danger, not the slow arrival of crowding out. Now, again, the Fed will be asked, hey, the Fed bought about $3 trillion of the $5 trillion of COVID bonds immediately to hold down interest rates. We are back to World War II Fed Treasury relations. Forget 1972 and Joe Bonning, forget the Phillips curve. What it's about in COVID and what it will be about next time is the Treasury wants to issue debt and they want the Fed to hold long-term rates down so that they can issue debt without the interest costs on the debt. That is the issue going forward. Now, will the Fed do that? I can't imagine that it won't. And I can't necessarily imagine that it shouldn't. The Fed has a price stability mandate from Congress, but think about what it means. We're trying to fight a pandemic, a war, a crisis. We need to bail out a failing financial system. And you guys think inflation's a problem, and you don't want to help us by supporting government bonds. You want to force us to raise taxes and not spend to meet the crisis? You must be out of your minds. Congress would immediately say, Fed, do it. And Congress might have a point. We would not want to have lost World War II on the altar of no inflation. Or maybe we would want to constrain the government. Hey guys, the Fed isn't going to bail you out next time. Get your act in order so that you have fiscal space. It will be lovely to think about that ahead of time. But that is the issue for Fed independence going forward. Well, doom and gloom, John. Why are bond markets only 4.3%? This question has been asked of me for 25 years. When I have a sign in my office saying the end of the world is coming, and interest rates keep going down every time I bring out the sign. We've been wrong for 25 years. And I think what bond markets say is, calm down, after dinner speech to get people riled up. This is a great country. It remains a great country. As we discussed from Karen's talk this morning, the debt problem is easy if we just get about 2 or 3% of GDP of primary surplus. It's not the debt, it's the surpluses, the deficits. If we default on the debt today, we still got 3% of the GDP deficits. Got to solve and once you solve the deficit problem, the primary deficits, if you can go to primary surpluses or just primary zero for 20, 30 years, we can pay off all sorts of debt. That's the problem, and it's easy to do. We did it this morning. 3% value-added tax, done. All of the sensible, index Social Security to inflation, not to wages, done. It's a political problem. So I think bond markets say this is a great country. Sooner or later, these morons will do what they've done every time before and pass a 1986 tax reform, a 1982 Social Security reform, and things will be fine. But nobody ever sees the Spanish Inquisition. Nobody ever sees a run coming. If you knew a run would happen tomorrow, you would get your money out today. that faith can change very quickly. So bottom line is all government debt, nominal government debt in particular, offers disaster insurance to governments. When you buy it, all investing is risk and return, and most of the risk you're offering is you are writing insurance. When you buy government debt, you are offering governments the chance to once in a generation give you a big haircut to get their way out of a crisis. Charge a decent premium, or make sure that the premium you see in the market is worth your sense of the probability of that event, and mind your betas. Does that government default event, that big inflation, does that happen at a time that's particularly bad for you? Probably yes if you're running a business, maybe not if you're a retired professor. Mind your betas, like everything else. Who should write insurance is what financial markets are about. So, summary, that's the danger of government debt. I've told you 3 stories. I told you the story of the index perpetuity, why long-term index government debt is a great asset. I told you the story of the Lucas-Stokey state contingent default. That's the risk you're signing up for and the dangers we face. But cheer up. I said what happens in other countries can happen here. What happens in Switzerland can also happen here. They have such a good fiscal system. Switzerland is an amazing country. Their main problem is to stop their exchange rate from appreciating. They're the only country in the history of the world that has ever lost an exchange rate peg in the upward direction because they were unwilling to print all the money that everyone else wanted to have and to take portions in return. Nope, we don't do that. We're too thrifty. What happened in Sweden can happen here. Sweden had a debt problem. They had an out-of-control welfare state. They reformed it. What happens in Argentina can happen here. Now, I said that originally as debt crisis, but Argentina defaults. But Argentina also, believe it or not, and I tell this anytime someone says it's politically impossible, Argentina just elected a libertarian president whose dogs' names are Mises, von Hayek, Robert, and Lucas. He cut the primary deficit of Argentina to surplus in about 3 months. He stayed there, and it stayed there. So we'll see how long that one lasts, but it is possible. Our government, our voters, America always does the right thing after we've tried everything else. We're working hard on trying everything else, but there is a right thing out there. And all of us, which is a very diverse group, can see what that right thing is. But investors, in investing, hope is not a strategy, and investment starts with risk, and those risks are present. Thank you very much.